From New York City for our viewers worldwide, I'm Manus Cranny in for Jonathan Farrow. Caution on the markets. The risk is a wrecking ball arrives on risk from the Fed, from tech, and from that jobs report. Countdown.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up on the show, a cautious start to a blockbuster week for earnings. Traders looking ahead to the Fed and U.S. jobs report. And President Biden faces mounting pressure to confront Iran. We begin with the big issue, gearing up for a huge week ahead.
We're in a situation where there are a few more nerves in the market.
An important week.
The Federal Reserve.
Its payrolls.
40% of the S&P market cap reported.
All the mega cap companies, Amazon, Apple, Alphabet report.
When you think about what has been holding up the market, has been propelling us higher, it's those big tech companies.
From a profitability perspective, tech is likely going to be the sector that can deliver.
When we look ahead to the Fed,
officials will more clearly outline how they're thinking about rate cuts over the next year.
Is this a Fed that's looking to cut rates as early as March, or is this a Fed that's waiting to kind of take their time?
I think he's going to say that there's been progress.
There are some signs that because inflation has come down so much that we should already begin to see soon the Fed begin to cut rates.
One of the key pillars to economic activity remains the labor market.
Under the surface, the labor market is cooling.
That's a lot of event risk for this week.
There are many swords of Damocles across these markets. JP Morgan's Jack Manley weighs in on the road ahead for the markets, writing this. The recovery thus far has been narrow and driven by multiple expansion. We're looking for a broadening out, agnostic to sector or style, with the emphasis on security selection. My guests this morning are Jack Manley, who uttered those words, joining us alongside Morgan Stanley's Brian Weinstein. Okay, so here we are. You want to go for breadth, Jack Manley, but there's a certain constraint on you. You've got to have a certain proportion of Mag 7. How much breadth do you want to take? Good morning.
Well, good morning, Manus. And, you know, the good thing about this problem that you pointed out here is that there's nothing wrong with the Magnificent Seven, right? We like these large, growthy technology names that are domiciled here in the United States. You know, I don't think anybody would look at you and argue with a straight face that technology will be less important in a decade from now, that artificial intelligence doesn't have the potential to fundamentally transform the world. I think the big question that we're all asking ourselves right now is what to look for over the next 12 months, and have some of this future innovation kind of been pulled forward over the last 12 months. When I think about the broadening out of the recovery, yes, there has to be this emphasis on security selection. I don't care a whole lot about style boxes at the moment. But the thing that kind of underpins the overall story here is going to be a bias toward quality. And quality in this case, Manus, means things like dependable earnings growth. It means strong balance sheets. It means reasonably attractive valuations. And that emphasis on quality is going to be linked directly to the interest rate environment. You know, a lot of talk this week about what the Fed may be doing, whether they cut in the first half or the second half. The general story is that rates are moving lower. But we also know that they're not going back down to zero anytime soon. And if money isn't free, we have to be more thoughtful about how we're allocating our capital. So some of that Mag 7 in the returns this year is totally fine, but we want to look beyond that, given where the interest rate environment is going.
Okay, so there's, look, the daily conundrums of when will the Fed cut, how much will they cut by. Brian, good morning, good to see you. For you, what would breadth and taking a slightly broader perspective on risk be?
Totally agree. I mean, you can see it in the fixed income markets, right? There's been a broad-based rally in high yield spreads and IG spreads. And so I think you are seeing a broadening out of the rally. And AI is not only going to help the Mag 7, it's going to help any other number of industries and companies that can survive a non-zero rate environment. So I think with that backdrop, broadening out makes total sense. And rates have probably peaked. The Fed will be easing, I think, in the first half of this year. So there will be more supportive borrowing, even for companies that aren't quite as high quality as the ones we've seen rally so far in the last year.
I think it just depends on what kind of cuts we actually get and whether they're preemptive or prudent at the Fed. And speaking of which, all eyes will turn to the Fed on Wednesday as we brace for the decision from the Chair Powell and his team. The news conference will follow. Mike McKee will be locked and loaded and ready to go on this. Mike, so what are the nuances that I need to focus on?
Well, not a lot of nuances at this meeting because the Fed has pretty much told us what they're going to do. We can expect an unchanged Fed funds rate, and they'll probably drop any additional policy firming language to make themselves neutral and not leaning towards higher rates. Talking about QT policy ahead, that's what the market wants to hear. Are they discussing any kind of taper? And then any hints from Jay Powell on rate cut timing. Here's the debate that's out there. The case for holding rates steady. You mentioned it earlier. We're seeing GDP rise. We're seeing consumer spending stay strong. And the white line there is the Atlanta Fed wage tracker. As you can see, it's still elevated, 5.2% gains for people on wages. Are we going to have higher inflation because people are still getting a lot more money and the economy is a lot stronger than people thought? Wall Street tends to think so, or at least that's the bet right now, that we won't see it because they're not betting on anything in March, but May, June, and July. By the time we get to July, they think we'll have 3 cuts already done. But the case for cuts is this, that at this point, because the Fed has raised rates and inflation is going down, real rates are moving up, and the Fed doesn't want to make conditions any tighter, even though the economy is strong. So in order to keep financial conditions about the same, they will cut. That's the debate out there, and that's what we'll be asking Jay Powell about on Wednesday, even if we don't get any moves from the Fed on Wednesday.
Okay, Mike, thank you very much. It's still a towing cost for the market whether we go 50-50 on Wednesday. Jack Manley, Brian Weinstein is with me to debate this. So 3 cuts by the market by July, which some would say is prudent, practical, and protective to the landing. Jack, would the 3 Ps stack up for you? 3 cuts by July?
I like the 3 Ps, Manus, but I don't agree with it necessarily. I don't think it's prudent. I think it's aggressive, and I think it is largely unnecessary. You know, this is an economy that is very clearly slowing down, but we are not slamming on the brakes at the moment. We don't need that extra stimulus that would come from a lower Fed funds rate, and I think the Fed is going to be very comfortable holding interest rates where they are right now, looking for further improvement, not just in inflation, but in particular on the wage picture. And we're going to get a little bit more clarity on that this Friday. I am very much in the camp that our first cut is going to be a back half cut. I'm looking for 75 basis points lower on the Fed funds, maybe a little bit of upside risk to that number there, but not by a whole lot. And the problem there is that the market pricing in all these cuts ahead of time may be a little bit disappointed. We could end up with some multiple compression if they don't get what they're looking for out of that Fed rhetoric.
And if we take it across to you, Brian, I mean, here we are. They've got all the reasons in the world to go ahead with these cuts. PCE is being well behaved on a 3-month, on a 6-month basis. It's acting beautifully. You've got a fairly robust consumer, but they have got the cover to be prudent, don't they?
Listen, I think I've been in the May camp. I'm moving more to the March camp. I think they're only going to do 100 this year. So, and I totally agree that the market may be disappointed when it's all said and done. But I think what the Fed wants to do here is just say, listen, if neutral rate is somewhere between 2.5 and 3.5, and inflation is slowing, then you don't stay at 5.5, right? You have to start to lower the rate. And if that's true, it's not going to be more true in May, right? It's true now. In fact, inflation could start to tick up by the middle of the year. So I think you get them front loaded. I think 75 in the first half of the year actually makes sense, with not too much more to follow. So we end up in the same place, but I think those rate cuts come sooner.
Brian, I'm drawn to your view that we get a change in leadership in energy banks and slightly more defensive. I mean, are you waiting for some kind of a mini drawdown, a mini draw for breath in these markets before you step in and load up in a change of leadership?
Yeah, it's been a rough strategy to wait for dips in this market. No, listen, I don't think that you're
going to get... It's called weaponized FOMO. It's called weaponized FOMO, Brian. I have it on good authority.
Yeah, that it feels like that. No, I don't think you need to get. I don't think you need to get big dips. I think you're seeing idiosyncratic pain when companies miss or disappoint. But no, I think this could broaden out if the Fed does ease early. I think this could broaden out without I mean, obviously you can get some dips here and there, but I don't think you're going to get super cheap valuations if the Fed plays this the way the Taylor rule says that they should.
And, you know, Jack, if we take it back to you, you say large caps are more expensive relative to smaller, but then you would say large caps can play they can take a lot more rough and tumble, a lot more of punches relative to the small caps. So you're not a buyer of value relative to growth at this stage, I take it.
Not a whole lot, Manus. I mean, I do like that large cap story right now. Yes, they are expensive, but I think in particular, when we look at the composition of the large cap index, it is a duration heavy index. It is an interest rate sensitive index. It is very long-term focused because it is technology biased. And what that means is that investors aren't buying these names for what they're going to do over the next 12 months. They're buying these names for what they're going to do over the next 5 to 10 years. The valuation environment doesn't really scare me a whole lot. But beyond that, there is a lot of quality behind those large cap names, right? We look at the composition of their debt. A lot of it is fixed rate, not floating. A lot of it matures after 2030 as opposed to before it, which is in contrast to what you're seeing at a small caps. These names are profitable. And if they have good balance sheets, they're able to absorb some of this wage pressure that we've been seeing and will likely continue to see on Friday. So large cap, I do think, still makes a whole lot of sense. And, on the value versus growth story, I'll bring it back to that earlier comment. It's not one or the other. It is going to be both. I guess if I had to pick one style box, if I had to get pigeonholed, I'd lean more into those value assets, those cyclical parts of the market. But there are, I'm sure, plenty of high quality, reasonably valued growthy names out there as well. That's why this emphasis on active management is so important as we move through this year.
Jack, you make me chuckle inside that you remind me that investing is in theory, a 3 to 5 minimum year horizon, in which case it's only when age hits you, gentlemen, that you begin to realize what 5 years forward means. Briefly to both of you, would you pick off some 10-year paper at 410? Is that a reasonable return? Because I haven't seen yields like that. I missed the 5% boat. Should I pick up the last 4 handle? Jack?
On me, yeah, I think so. We had such a rally in the bond market in the last couple months of last year. I think the duration trade is mostly played out. I'm looking for coupon this year, and that's a pretty decent one.
Clip me up. We'll come back to you, Brian. Don't worry. There's more work to do. Jack, Brian, stay with me. Your morning selection of risk on Bloomberg. Joining me now to look under the hood, ahead of the opening bell, it is Abigail Doolittle. What have we got, Abby?
Well, we have the U.S. futures basically flat, but beneath that benign surface, Manus, we do have quite a few movers, starting off with the shares of Sofi. They are soaring, heading to their best day potentially since July of last year. The online bank posted its first ever profit of 2 cents, a small profit, but nonetheless better than the loss expected. And they also talked about how 2024 is to be a transition year of growth toward financial services, a little bit less lending. American Airlines up 1.3%. Citi has upgraded the stock to a buy from a neutral on the airline's ongoing deleveraging process. And then finally, iRobot plunging down 19%. Amazon has dropped the $1.4 billion deal on a clash with European regulators who were threatening to block the deal. This stock, since that deal was first announced back in August of 2022, well, Manus, it is now down about 72%.
Okay, thank you very much, Abby. Let's see how we open today. Coming up in the show, it is a big week for big tech.
When you think about what has been holding up the market, has been propelling us higher, it's those big tech companies.
We take a look at the 5 heavy hitters on the slate this week.
When you think about what has been holding up the market, has been propelling us higher, it's those big tech companies because they really have an outsized influence, not just in terms of price performance, but in terms of earnings. So we certainly do hope that those companies deliver.
In case you hadn't noticed, it's going to be a big week for tech. You got Microsoft, Apple, Alphabet, Meta, Amazon, all reporting. Now, the 5 of them have a combined market value of $10 trillion. Joining me now is Katie Greifeld to go through what we can expect. Katie.
I'm going to say that one more time because I think it's amazing. You think about Microsoft, Alphabet, Meta, Amazon, and Apple, $10 trillion in market cap, all due to report between Tuesday and Thursday. Like you said, it's going to be busy. So let's talk about positioning here, because when you focus on just the Magnificent Seven, you have 5 represented here in that grouping. You take a look at the group's average 30-day implied volatility. It's actually been rising compared to the VIX, which is going absolutely nowhere. But then you take a look at the volatility on these specific names, and it's pretty historically cheap, Manus, most dramatically in Amazon and in Meta. If you take a look at Amazon options, they implied a 6.2 one-day move after earnings. That compares to an average move of about 9%. Then you focus on Meta, it's even more dramatic. You have options there implying just a 6.5% post-earnings move. That compares to 14.9% on average. So it's interesting here that you don't see traders really reaching for protection, even though a lot of these names are trading close to or at their all-time highs. You remember Microsoft last week hitting $3 trillion in market cap. Of course, we're going to find out soon enough whether or not that was the right move to kind of forego insurance here. But of course, it's going to be very, very consequential these next couple of days to figure out how sustainable this big tech rally truly is, Manus.
Yep. Well, certainly, you know, volatility is cheap. There's no doubt about it. It could take a little bit of a spike later on this week. Katie, thank you very much for setting the stage. My guests this morning are Jack Manley, Brian Weinstein, to discuss these markets. Two things that go through my head when Katie lays out the board of risk, which is I've had various people come on and they say, I want a little bit more cash. I don't quite want to buy volatility because it's a waste of money. But how do you protect yourself for a mini jolt in this market? Jack?
Well, I think the first thing is to step out of cash, but you don't have to take a whole lot of risk on that front, Manus, to find some pretty attractive returns. I mean, we look at high-quality, intermediate duration fixed income as almost a slam dunk trade this year. Yes, a lot of that return happened in the last couple of months of last year, but with where coupons are right now, I still think you have a pretty decent floor in terms of return potential without taking on a whole lot more risk than maybe traditionally associated with a cash-like investment, if you want to call it that. But I think it also is about finding those names in the S&P 500, call it, that are now actually punching above their weight class from an earnings contribution perspective. You know, this is a very important week for earnings, of course, because these are the largest names in the index. It's also because this earnings season has been pretty disappointing, and earnings in general have been somewhat disappointing. You know, we look at the 10 largest names in the S&P 500. They are bigger than they have ever been in history, accounting for around a third at market capitalization. But they're only contributing about a fifth of overall index earnings. There's a disconnect there, and that's reflected in those multiples. So finding those other names out there that are actually punching above their weight class from an earnings contribution perspective, that's another element of this strategy as well.
It's interesting because you put context around what's going on below that index hood level. Brian, if I said to you, are you disappointed with the earnings season so far, or where do you see the other opportunities?
Yeah, listen, I'm not disappointed. It's hard when you come into January and everyone wants the themes to change, and then you have the same stocks take leadership again, and people get frustrated. But no, I think under the hood, you can see investors are looking to move that cash. I think the way you protect yourself is you do move out of cash a little bit, right? That yield's not going to be around forever. So totally agree on short fixed income. By the way, I'd throw some tips in there. I think real yields are cheap. The Fed wants them lower, so that's one way to play it. And then yes, you have to buy some of the parts of the market, the S&P or whatever index you choose, that haven't participated in the rally as much, that investors haven't chased, that have good earnings. Some of them have great dividends too and great yields. So you can find ways to earn income in this market and find some safety away from just owning the same stocks that have worked. And I do think that theme will play out in the next couple of months.
Can I ask you briefly, we're up against the clock, so I want to get a sense from both of you. I'm always curious. We talk about the flow, the most concentrated stocks, the Bank of America survey, the most concentrated since 2021 on tech. To what extent do you look at flow and concentration risk, Jack?
I think concentration risk is a big problem right now. It's not going to be a big problem forever. This disconnect that we see between earnings and price, I guess you could say, is a temporary one. Those big names are high quality. They will get that earnings growth back. They will get those earnings numbers better. They will grow into those multiples. So for now, it's an issue, but I don't think it's a permanent one.
And Brian, for you, are you bothered by the flow show? I love the flow show. Don't break my heart. Don't shatter my dreams.
No, I don't think it's fascinating, right? And there are examples of when parts of the market have gotten so large and investors have owned them at exactly the wrong time. So that fear is in the back of your head. But no, I think in this case you want it to resolve itself in a positive way. Other companies doing better, catching up a little bit, but I don't think you're going to see a big change in the leadership in terms of the percentage breakdown of the market for a long time.
Look, we're constantly trying to understand geopolitical risk. You've got freight rates rising, the Red Sea tensions rising. I don't want to get lost in the mire of how America responds to the most recent incident over the weekend. But I do want to contextualize your view on the risk of a respike in inflation here in the U.S. as a result of geopolitics, or is it a very European problem? Jack, brief and sweet.
I think it's mostly going to be a European problem unless we see some problems with energy, and then that becomes a global issue that becomes a little bit insidious.
And Brian, for you, wrap it up.
I think you file at the back of your mind as, when the Fed does start to ease, is inflation going right back to 2? Is it going to stay down there? I think there's some reasons to believe that late in the year you want to start worrying about that story playing out. For now, it's more of a European issue.
Okay, well, we'll keep an eye on those flows. It's interesting to see the oil market this morning did 6% last week, but actually very, very little this morning. And we wait to see what the substantive, if at all, substantive response it is from the White House in terms of blaming Iran on these attacks over the weekend. Jack, thank you very much. Jack Manley, Brian Weinstein. Their thoughts this morning on markets. Coming up on the show, your morning calls, and a little bit later on, we're going to catch up with Lori Calvasina on her calls in this big week for tech earnings. $10 trillion to hit this slate between Tuesday and Thursday, right here on Bloomberg. Quick snapshot of what's going on in markets. We know there's $10 trillion worth of equity risk coming down the pike, but you have a quarterly refunding statement. You have a Fed which could pivot even more aggressively to an even easing stance. Yields are dipping ever so slightly, but it is the quarterly refunding and the jobs report which can materially move these bond markets. You've just heard from our guests talking about 4.3% and 4.1% as being appealing for them as far as taking in some coupons. Let's roll it over, have a look at the equity markets. You'll hear it time and time again. There is $10 trillion worth of equity market cap coming to bear on the market. At the moment, you've got 3 months of a rally, up 18%. Is there any sign of exhaustion of that in the market? NASDAQ is up an 8 to 1%. It is big tech risk that is going to drive sentiment after the close of business tomorrow evening. In the meantime, this is what the scribes of Wall Street have got for you. We have Warner Brothers downgraded by Wells Fargo to equal weight with a PT of $12. Lower earnings is the citation. Norfolk Southern is cut at both Morgan Stanley and Stifel. Analysts flagging that the company needs to catch up with its rail peers. And finally, Colgate-Palmolive, raised by Raymond James to outperform. The analysts see the upside opportunity for the household products this year. Have you bought a tube of toothpaste recently? The price is incredible. There you go. Colgate-Palmolive up 0.6%. Coming up, how rich is Lori Calvasino's blood for a little bit of tech, or is there breadth on the way? What does she expect from the earnings this week? Nearly 40% of the S&P market has reported. The results are in. My last guest says it was slightly underwhelming. Will she agree? On Bloomberg. We bring you American culture and markets here. The Gronk from the Patriots. I learn something new every day. There you go. Flutter.com. They're on the move. You've got equity markets up 18% in the past 3 months. We know it's going to be a big week for tech. But there's also Fed risk. What will the Fed deliver in terms of perhaps a dovish pivot? There we are. We're rolling over to the cash opening. You can see he draws a crowd. That's not for me. That's for him. Equities are up, as you can see. Can we hold on to the gains? And a number of stocks that are going to be on the move. We'll go through those in just a moment. Keep an eye on the euro. The euro is down. The dollar is bid because you have Francois Villeroy de Gallo again commenting over the weekend about the proclivity for rate cuts in Europe. Will they go first? Will they do more? Is April on the slate? We will have to avoid two risks that become balanced. So they are talking more about the timing of rate cuts in Europe relative to the US. 10-year yields trade flat at 4.10, and crude is down 0.75% despite the heightening tensions and geopolitical risks. Will Kennedy will be with me very shortly to discuss the nuances of the oil market. Two stocks that we are watching, iRobot and Amazon, the tech giant, dropping its deal with Roomba. the maker, after clashing with EU regulators. Abigail Doolittle is with me. I think I have a rumba.
Do you really? Maybe I should get one, make life a little bit easier on the weekend. Relative to iRobot, it's a rough day. The stock down more than 17%, down 4 days in a row over that time period, losing about 25%. But this is not the only news. The CEO has stepped down, and they are cutting 31% of their workforce. Now, clearly, the big news, though, is Amazon dropping the $1.4 billion deal. This after, as you mentioned, EU regulators questioning or threatening to investigate whether or not it would keep away competition from the marketplace. And this is a sign of the intense pressure that Amazon is under to not create a lack of competition. So instead of answering to some of the questions in the investigation by the EU, they are choosing to walk away and instead pay iRobot the $94 million termination fee. This is similar to a decision made by Adobe walking away from a $20 billion potential acquisition that did not happen, of startup Figma. Another reason to not go through with the deal, though, is that recently and over the last year or two, Manus, iRobot has really seen a reversal of fortunes after the pandemic boom of people being home. Not so much sales, a lack of profitability. The stock, since announcing the deal back in August of 2022, is now down more than 75%.
Okay, Abby, thank you very much. Shifting tides of the EU on regulating deals. Let's turn to the chips, and never far from our mind. Elon Musk says he plans to buy semiconductors from AMD as the EV maker loads up on AI hardware. Ed Ludlow, good day to you. Back in your hometown. What's going on? What's Elon buying now?
Well, this is curious because, as you can see on your screen, AMD is now softer by 0.9%. It had been up 1.5% in the pre-market, and that was partly, again, driven by a single word, which is yes. Elon Musk was asked on X, the social media platform, will Tesla buy AMD chips? And he just responded saying simply yes. But it was in the context of some commentary from Musk about their $500 million spend on NVIDIA hardware, and which is a reference to not just their H100 GPU, but DGX or HGX, the server design that goes into data centers and powers both LLM training and on the inference side as well. There were some other catalysts in the market that are kind of interesting. There were 2 stock upgrades on AMD, which is continuing to be down 0.9%. One from Susquehanna, which is bullish on the prospects of AMD's AI accelerator. It's the product that they want to compete with NVIDIA on, but it only just started shipping in volume in the quarter gone. And similarly from Morgan Stanley raising its price target, also bullish on the long-term AI opportunity. I'm trying to work out what's going on. You look on the Philadelphia Semiconductor Index, most of the names there are in the green, and it's a pretty even split of those names in the green and in the red on the NASDAQ 100, but AMD's decline's accelerating 1.4% now, having been 1.5% higher in the pre-market. Happy Monday.
Happy Monday. Go figure. You know, there's a couple of analyst notes out there as well to consider. Ed, thank you very much. Let's stay with the chip makers. The Biden administration expects to announce billions of dollars in new subsidies to chip makers that include Intel. Now, this is according to the Wall Street Journal. Katie Greifeld is side by side with me here. Katie, what are the details here? What's the ambition?
Well, according to those reports, of course, those grants could be awarded in the coming weeks to the tune of billions of dollars, as you say. And this is really part of the U.S. CHIPS Act. You think about the goal of that act, and it's to bring chip making back to the U.S. and also counter China's growing chip making industry. So that's the ambition, and that's giving a little bit of a boost to Intel, or at least it was pre-market. You can see it's down now, and that's because Intel is really fighting against its own fundamentals here. Remember, we heard Intel's earnings report last week, and it gave a disappointing first quarter forecast for both sales and profit that really sparked fears that this long-promised comeback bid for Intel has been derailed at some point. Now, you have the PC business when it comes to Intel, that's recovering, but when it comes to data center processors, you see that demand is weakening there. You add it all together, and that translated to a nearly 12% plunge for Intel on Friday alone. Of course, the CEO, Pat Gelsinger, he told Ed Ludlow and Caroline Hyde last week that reaction was overstated, but that's the overhang today. You can see Intel bouncing back and forth here, of course, even with that potential White House support in the offing. We'll see how this plays out.
Yep. Underwhelm, and this market will quite literally be vicious with you. Katie, thank you very much. Katie Greifeld there. Turn to the earnings. You've got Sofi reporting first ever profit earnings, topping out on the estimates. So Foxman is with us. So what have we got? The stock's up 16%, Simone.
Yeah, an enormous surge this morning, Manus, after results that Mizuho called outstanding. The company able to turn a profit of $48 million in the fourth quarter. That's up from a loss of $40 million, and that equates to about 2 cents a share. Adjusted net revenue also coming in ahead of expectations, up 34% year on year, and your membership count rising 44% year on year. Now, Sofi describing this as a year of transition in their earnings statement, where tech and financial services are going to start outweighing the growth of its traditional lending space. So expecting like a 50% compound revenue growth for financial services, mid-20s for its tech platform, which has to do with banking infrastructure. Well, it still sees mid-teens growth in lending, and we saw some of that in the earnings, where originations were really the only thing that kind of missed the overall consensus estimate. But Anthony Noto, the CEO, saying that growth in high-quality deposits has actually lowered the cost of funding for the company, also announcing some new business lines, investments in alternative funds, mutual funds, through its Sofi Invest platform. Now, it's worth noting that shares are still down about 10% roughly month to date. After there were concerns about the prospects of consumer finance, Morgan Stanley had expected, for example, that most of those companies would miss, but clearly not the case with Sofi, and we're seeing the reaction in the market this morning, Manus.
Yeah, a plum move, up 18%. Simone, thank you very much, rounding it up there. Let's stick with the earnings theme. RBC's Laurie Calvasina weighing in on what to expect. Companies have tried to strike an optimistic tone in the first batch of earnings calls, with consumer resilience, macro risks, and the theme of normalization emphasized. There's nothing normal about these markets, Laurie, is there? 18% in 3 months. It's record after record. I mean, I'm breathless trying to be enthusiastic about it. How priced to perfection is this? Or when you look at the PEs, you would actually still say elevated, but you're not alarmed.
Yeah, so thanks for having me as always. I would say from a valuation perspective, I think markets have been fairly priced. If you look at data going all the way back to the 1960s and look at where PE should be in light of moves in inflation, interest rates, GDP, and where those things are expected to be at the end of this year, our model would tell you that stocks ended basically where they needed to be at the end of last year, and there's still, a decent amount of upside through the end of this year. We actually found in the update of that model that we published over the weekend, it's pointing to a bull case of 5,500 on the S&P. That's not my target, so don't get too excited. I'm still at 5,150, but that just gives you a sense of, maybe how much more one of our bullish models has been saying we could actually go, and it would still be rational. I think if you look at it from a slightly different angle, from sentiment, things do seem a little bit more precarious. And so if you look at CFTC data on U.S. equity future positioning on the buy side, we're basically a little bit above highs that we saw back in 2018 and 2020 pre-COVID. If you look at NASDAQ futures positioning, that's back to the 2013-2015 highs on the buy side on a notional dollar value basis. And if you look at the AAII survey, that started to come down a little bit the last couple of weeks, net bullishness, but it's been at a level about 1 standard deviation above the long-term average, where markets are typically flat over the next 3 months. Okay. So I think valuations are okay, but sentiment is a problem.
So you're only leaving me 200 points on the upside on the index. So that must fill you with dread on how to allocate, does it?
Well, look, I think that there is some upside between now and year end. Again, we've got that 5150 target. There are some headwinds we have to work through, right? Expectations for a sluggish economy. I think that's dissipating. If you believe that GDP forecasts are going to continue to move up as they have been since the fall, as they have been since last summer, that would, kind of push you into some of the more cyclical areas of the market, like financials. But I will admit to you, I do think that it is a very uncertain year. And I think that we do have there's a lot of difficulty, I think, with picking sectors at this point in time. We have a few of our favorites, but I think this is the toughest sector picking environment that I can remember.
You mentioned the sentiment surveys, AAII. You talk about the retail investor. We're coming up to that time of year when bonuses will get paid, when people will think about what they want to do with their 401ks, and you're going to get chunks of money arriving. So is March and April a sort of a pivotal period of time on the next evolution of bullishness?
So I think it's interesting that bullishness has started to wane just a little bit. I actually feel if I look back over, the time I've covered equity strategy on the street, right, and I think about big moves and funds flows to start the year, I feel like those really happen in January, to some extent February, and by the time you get to March or April, it really feels to me like you've run the risk, actually, frankly, of seeing some of those reallocation trades peter out, and then people go back to the same old themes. So I think we'll see what ends up happening. We certainly did see a rush of money into things like small caps and value in the final couple months of last year. And that sort of turned on a dime as 10-year yields started to back up again. I think that, frankly, we're just going to have to be prepared for a whiplash in narrative again this year, the way we experienced last year.
What does whiplash mean for investing?
Whiplash means that you have to be diversified. And so if you think about our sector overweights and underweights, we do have a little bit of a tilt towards value. We have a little bit of a tilt towards defensive. But on the defensive side, we've got an overweight to healthcare, which tends to be a little growthier. And we've also got an overweight to utilities, which tends to be a little bit more value oriented. If you think about some of my market weights, we're actually neutral, all three of the big growth sectors, tech, comm, services, and also consumer discretionary. And I think you really don't want to go underweight those areas. I do think it makes sense to pull back on them a little bit, to trim, to add more to the value and cyclical part of the markets. But at the same time, I do think underweighting them could be pretty dangerous.
When you look around the world, we're going to deal with some other global stories this morning, which is China stimulus, which is about blockages in the Red Sea, the risk of divert and freight rates rising. Within an American construct, within the U.S. equity construct, are any of those a material headwind?
So I think we always care about the inflation story, right? I think a lot of the repositioning we saw at the end of last year, a lot of our calls, frankly, and I think a lot of the calls around the street hinge upon the idea that the Fed will start to cut later this year. And for the Fed to cut, you do need the inflation story to cooperate. I don't think the Fed is going to be that forgiving if inflation rears its head again. They view that as really the central part of their job right now, and they're not wrong about that. So I do think we have to keep quite a close eye on that. I do think the China story is quite interesting. We haven't really had too many conversations with people about China. It felt like a very, very crowded trade on the long side this time a year ago. But money flows did improve when we looked at China at the end of last year. And now it feels like, the narrative is starting to change there just a little bit. So we're watching that one very, very closely because I do think laggards have generally been interesting to people recently.
Okay, you're the first one in a while that's actually suggested that maybe it is time to review the positioning on China. Laurie, thank you very much. Laurie Calvasina, my guest on the markets this morning. Coming up on the show, the U.S. vows a response to a drone attack killing 3 soldiers at a base camp in Jordan.
I'm not going to telegraph or forecast any potential response from the United States because of this attack, other than to say there will be a response.
We have the details on the options that will be on the table right here on Bloomberg.
We will take deliberate, appropriate action. Our focus here is not to broaden a conflict from the very beginning. We've been very focused on ensuring that the situation in Israel does not broaden into a wider regional conflict. Unfortunately, what you have here are Iranian proxy groups that are exploiting the situation and conducting these types of illegal attacks against forces that are in the region to actually preserve peace and stability. So, again, we're going to do what we need to do to protect our forces, while also cognizant of the fact that what we don't want is a wider regional conflict.
That was the U.S. Department of Defense press secretary speaking to the team a short time ago, and it comes as President Biden is under pressure to confront Iran after 3 American soldiers were killed in a drone strike on a U.S. base in Jordan. The attack claimed by Islamic Resistance in Iraq, a group aligned with Iran. For its part, Iran says it had nothing to do with the attack, saying in a statement, the resistance groups in the region do not take orders from the Islamic Republic of Iran. Katie Lyons has been checking the various responses and is in Washington. I mean, this is the standard cover note from Iran. The question we need to ask ourselves is, are they still in control of the proxies? Here we are. And indeed, what response, what scale of response will America bring to bear?
Well, Manus, that's what we're waiting to find out. The U.S. has vowed that there will be a response. The president yesterday saying those responsible for this attack will be held to account at a time and in a manner of our choosing, keeping in mind here that this is the first time we have seen American troops killed since the war erupted between Israel and Hamas on October 7th. And of course, dozens more were injured as well, which is why there is much pressure on the president to respond in an appropriate and significant way. What that response could look like can vary. Obviously, there is less provocative approaches like hitting perhaps Iranian targets abroad, but there are some on Capitol Hill that are pushing the U.S. to strike Iran directly on its own territory, the likes of Senators Lindsey Graham and John Cornyn saying hit Iran. The thing is, the U.S. has not conducted a strike in Iranian territory in decades. And as we were just hearing from General Pat Ryder there, the U.S. very much does not want to see this conflict escalate any further. So they have to take that into account. Now, of course, Tehran, for its part, has also said it doesn't wish to see the conflict between Israel and Hamas erupting into something more wider regionally, but they have also said that they aren't going to prevent groups they back from doing what they think is appropriate to protect Palestinians in Gaza, retaliate for that, or to defend themselves. They say that anything suggesting that Iran is directly responsible for these attacks over the weekend is baseless, but still that is going to be the tension here. Something else to keep in mind, Manus, as we watch what is happening in the Middle East, is there was a summit in Paris over the weekend as well between Israeli officials, U.S. officials, Qatari and Egyptian officials as well, trying to work out a potential ceasefire deal in exchange for the freeing of 100 Israeli hostages that are still being held in Gaza. Israel's Prime Minister Benjamin Netanyahu has said that there was progress made, but there still are gaps remaining. So just watch for developments over that in the coming days as these conversations will be continuing. And we could potentially see a ceasefire deal once more.
Yeah, those spy chiefs from Qatar, Egypt, the U.S. and Israel meeting in Paris. Katie, thank you very much. Katie Lyons with the very latest. Let's turn to the impact on the rising Middle East tensions across the commodity spectrum. Will Kennedy is Bloomberg's senior executive editor for energy and commodities. He's here in New York for the week. What better man to bring into the conversation? Will, good to see you this morning. You know, you look at the oil price this morning and you go, sorry, did I miss something of size, or has the market... If I look at the performance over the past 6 days, we're up nearly 5%. Why is there not a more aggressive pricing response to very heightened events over the weekend in the oil market? Good morning.
Morning, Manus. Great to be here. There has been a response over the last couple of weeks, as you say. I mean, oil is trading higher, and it's made high for the year on Friday. Obviously, it hasn't gone higher today, and I think that comes back to something that you and I have talked about several times this year, is that none of these events have actually impacted the production of oil. So the oil continues to flow. Now, there are some blockages and delays in getting it to market, but ultimately it's taking longer to get there, but it is all getting to market. So there's no barrels yet lost in the market, and I think that people are cognizant of this idea that no one wants a wider war, and I think most people still expect it's unlikely there will be an impact on production.
Which then takes us back to the more prescient issue, which are the additional cuts that were promised to the market by OPEC+. And your responsibility is to monitor that. And the story today is there's a slow start to the new oil cuts. That's not going to happen. That's not going to make Prince Abdulaziz bin Salman incredibly happy.
No, but I mean, I think it's important that the Russians came out at the weekend and said that they are adhering to their cuts.
That was Novak over the weekend.
Absolutely. Yep. And, you know, when we look at the Russian exports, they are probably pretty close to what they said they would do. I think that one thing the Saudis will take heart from is perhaps the strength of demand as well, because, you know, there's always a balance to the market, and, you know, the economy here in the US is doing very well.
It is indeed. That's the IEA versus OPEC debate. But we'll talk about that offline. Will Kennedy there. Thank you very much. Good to see you in New York for the week. And some sector price action this morning. I wonder what's hot to trot. Abby, what have we got?
Well, it's interesting, Manus, because we have a very small gain for the S&P 500, but beneath the surface, quite a bit of action, starting off with the energy down 1.1%. So sticking with the topic of oil, again, that's the worst sector for the S&P 500. The rest of the sectors, though, smaller moves, but whether to the upside or the downside. Tech is the best sector right now, up 0.3%. So again, small moves. Over the last number of days, though, in fact, in the month of January, the top sector is communication services, up 8.5%, heading to its best month, Manus, since July of last year. A lot of this on Netflix's big quarter. We have Meta and Alphabet up. Will they continue the trend for communication sector? We'll have to see.
Okay. Abby, thank you very much. I really am trying to get into beef at the moment, but it's not happening. I'm lost on Netflix. Please send your suggestions in on IB. Coming up, the market moving events that set your agenda for today and the rest of the week right here on Bloomberg. Trading diary for the week. Tuesday, it is all about tech. Alphabet and Microsoft deliver their results. Roll on the Fed decision on Wednesday with the Chair Powell's news conference. The nuances are key. We then switch over to the Bank of England, and Governor Bailey will give us his view on the world. Amazon, Apple, Meta report earnings on Thursday. And finally, the crescendo for risk analysis. Jobs report in the USA.